Hello and welcome. You're watching All About Your Company, and this is ET Now, and I'm Saita. Today, we're going to be talking about Ajmera Realty. Why is this one in focus? 81% of their Vikroli project got sold out in the first 24 hours. So they're seeing very strong traction. Now, some of these real estate companies and the Nifty Realty Index hasn't done much over this year at least. In fact, if at all, we've seen a cool off. And therefore, I want to try and understand whether the traction remains strong and whether this sector could do well over the next 12 to 24 months. Really, that's the objective that we'll get to. And of course, we will go into granularity with regard to Ajmera Realty and try and get a sense of whether this one, 4,000 crore in market cap, is an interesting one or not. Let me first start off with that first question with regard to the Vikroli project and what is the traction in phase one. What is driving that traction? Is pricing holding up, and whether this allows them to kickstart phase two quicker than what they would have anticipated. Really, that's the first piece. The second question is, of course, with regard to phase two, whether it encourages them to launch quicker. The third piece is with regard to FY26 GDV. Now, a gross development value, which is all the development that they are currently doing, is around 6,500 crore. Again, they're adding to that around 6,400 crore this year, and out of which they've done just 2,100 crore in H1, and that also they did it at the fag end of H1. Does H2, do they have sufficient options where H2 is concerned, where they can clock in another 4,500 crore of GDV? That's the question we'll ask. The fourth piece is with regard to launches and approval pipeline. Now, mind you, one of the big concerns with regard to realty is whether the approval pipeline is strong and whether approvals are coming through or not. That's one piece that you want to identify. So we'll try and get a sense of whether that is coming through. Also, debt as well as execution. And a lot of the execution is linked to approvals. And with regard to debt as well, one wants to understand as to where the debt levels will go. They've guided for debt going up. For the moment, they've controlled that. So they are well below the FY26 guidance. That's the other piece I want to know. The momentum post-launches, both in Mumbai and Bangalore, they've had several launches. I'll name a few: Manhattan, Greenfinity, Eden, and their Bhandu project. Those are just 4 of the launches they've had. How's the momentum playing out? And in Bangalore as well, they have 3 projects, Iris as well as Marina among the 3. The last piece is with regard to pricing and realization. Now, the pricing has seen a sharp uptick. H1 FY25 price realizations were average realizations are roughly 23,000 rupees per square foot for them. That has gone up to 29,000 rupees per square foot. And that uptick, I'm trying to understand what's driving it and whether that number is sustainable or not, because that will also drive profitability, revenue, and the like to follow. They've guided for the next 4.5 to 5 years to have cash flow of around 2,800 crore. It's a 4,000 crore market cap company. They have plenty of land banks as well, and we'll try and understand valuations better as well. So we'll have all of this, obviously, as we always do, in AYC. Let's talk about the company. It was incorporated in March of 1968. So this is quite an old company. It's a Mumbai-based realty company. It predominantly operates in the MMR region. Now has diversified into Bangalore as well. So they have projects there. In terms of product, the primary development is residential, and they've delivered around 20.5 million square feet across 46,000 homes. They plan to deliver 1,000 homes this year alone, out of which they've delivered 533 in H1, likely to deliver the balance in H2. Now, in terms of the core products, it's residential, which is the primary revenue driver, 95% plus of sales. Those are the key areas they operate in. And the other one is obviously commercial. Now, in the commercial, they largely operate in boutique offices, which is just a 5% odd in terms of component of the total. And they operate largely in the sales model. They don't operate too much in the rental space, and therefore we will focus on predominant revenue share, which is 95% is residential. We'll focus on that, and we will focus on their projects which are ongoing, and we'll try to get you a sense of what next. With regard to the geography, I did speak about Mumbai. Now, in terms of the projects that they're operating in Mumbai, that's the total pipeline, gross development value. But in Mumbai, they have completed 136 lakh square feet of space within the residential as well as commercial space. Ongoing is around 6 lakh and future launches around 6 lakh. And future development potential. These are land banks that they own, and they own plenty of them. We'll talk about those land banks. Is around 105 lakh square foot. In Bangalore as well, they have 21 lakh square foot, which they've completed, 3 lakh ongoing, and around 1 lakh is future launches going forward. In terms of the upcoming projects, I did speak about that we will talk a little bit about it. Wadala is around 22.8 lakh square feet of carpet area available. They have that land bank available. That's 8,900 crore of GDV. Half of this likely will come on stream in the next 1 to 2 years alone. And Kanjurmarg as well, 29,000 crore rupees of GDV in the pipeline. That's 82.5 lakh square foot. Again, they have land available for both of these projects. And that could be a key value unlock, which is still available to them. 4,000 crore in terms of the market cap. That's something you want to keep your mind on. Now, let's talk about the metrics, as we always do. The financial metrics, let's start off with the profit and loss account. And in that, you'll see that the revenue growth has been around 15% on a YOY basis over the last 3 years. But it's been choppy, as is the case when you're looking at real estate in the execution side of things, because you have to wait for execution to play out for this revenue to get booked. And that's one of the key drivers in real estate numbers when you're looking at the P&L. When you're looking at the EBITDA, and that's grown at around 11%, you've seen a bit of margin choppiness, and that will come up for you on your screen as well. And net profit has grown at 40% on a compounded annual basis. But you will see choppy revenue, you will see choppy EBITDA margins and profitability, as is typically the case in real estate companies, because it's execution based. So you might get commitments upfront, but till the execution doesn't happen, you cannot book your revenue. And that's the way in which margins have gone. Let's talk about some operational trends as well. In terms of collections, you've seen it go up on a consistent basis. That is H1, the last bar there. So if you annualize that, of course, it's at 900. So you've consistently seen an uptick with regard to collections on a YOY basis. You look at the sales trends as well. You've always seen an uptick with regard to pre-sales trends, and you're seeing that in H1 of FY26 as well. In FY26 full year, they're expecting nearly a 50% plus growth on the pre-sales number, and therefore you'll see around 1,600 odd crore of pre-sales very likely. We'll speak to management about that as well. You look at the volumes as well. They've gone from 2.5 lakh square foot to 2.9 lakh square foot in first half, which will likely mean you'll do something between 5.5 to around 6 lakh square foot in the full year of FY26. The realization trend as well, you'll see an uptick, and a very sharp uptick. We spoke about this. You'll see that uptick. 22 to 23,000 was the realization per square foot, which is currently sitting at 28,000 plus. So just on a YOY basis itself, we've seen a sharp inch up in terms of realizations. Now so we've spoken about operational metrics. You've seen how well the company has scaled. Now let's talk about the balance sheet, because that's one key aspect of the scale that it will continue to gain. If it has to do that going forward, it has to have a strong balance sheet. You're looking at a book value of around 1,261 crore. It's trading at 3 times book, and the borrowing number is around 650 crores. So you've got almost a 1:2 in terms of, or 1:2 in terms of debt to equity. Therefore, 0.5 times is the debt to equity. You're looking at a cash bank balance of around 90 crore odd. So this is fairly okay. The debt to equity number going to 0.5 is not worrisome, but at the same time, it's not exactly zero. And there are certain companies in the realty pack where you have a net debt of near zero. So therefore, we've been cautious. We've given this neutral. Let's look at the cash flow as well. And in the cash flow, what you will see is your cash flow from operations aren't coming through. That has to come through, and that will come through as execution picks up. You saw that happen in FY24. FY25 was a muted year. We're likely to see that pick up as well. Also understand that a lot of the cash flow gets attributed straight to inventory because the inventory keeps building up. So as you continue to execute your projects, inventory builds up, and that amount either sits in the payable section or in the inventory section, and therefore you will see a lot of a lot of chunkiness in the working capital that you will see in the realty companies, and that plays out on the cash flow as well. When you're seeing net cash flow, it's largely flat, not exactly the most relevant metric to track. Let's talk about ROC, and you'll see that ROC was single digit, has just about come into double digit. Again, very, very neutral here. A 13% ROC. Can it go towards 15 plus? Really, that's what the Indian equity investor wants, and therefore, as it scales, it could likely happen. So we'll wait and watch for that trend to play out. Let's talk about shareholding. Now, shareholding is very, very strong promoter held. We've seen a bit of promoter selling that has happened, but outside of that, 68% promoter ownership, no FIs or DI interest. So that is something you want to be cautious about. But outside of that, just the fact that there's enough skin in the game for promoters, and that 3/4 or rather 2/3 of the company's value goes straight to promoters is obviously a positive. The balance sits in the public. Now let's talk about the guidance versus the actual, especially for H1 of FY26. You look at the okay, that's the total number of shareholders. So no real inch up or inch down, which is also a positive. Now let's talk about guidance versus actual. They've guided for pre-sales of 1600. They've done 828. So so they're exactly halfway there at the end of H1 FY26. Those numbers are incorrect. The FY26 guidance is 1600, and the H1 FY26 number is 828. Project additions to the tune of 3,750 crore expected. They've not done that yet, and therefore you want to see whether that number plays out or not. And the third piece is with regard to debt to equity, and debt to equity is expected to go up but hasn't done so in H1. Now let's talk about the valuations. Just the last piece. You'll see all of the companies. You look at Ajmera is trading at 31 times, but you look at Brigade 27, Oberoi 27, Godrej Properties 39. So that's broadly the range in which they've been operating at in trailing 12 months PE. Mind you, again chunky in profitability, but nonetheless PE is the right metric to look at real estate companies. And you look at the debt to equity that all of these companies have. It's anything between 0.2 to 0.9, with Oberoi having the best debt to equity as in comparison to the PE it trades at. So that's also something to keep in mind. Again, very, very neutral here on Ajmera, largely also because the last 5-year valuations, it's traded at around 20 times 5-year average. So that's the other piece that you want to keep in mind. Now, it's that time where we bring you the entire snapshot. There you go. So except for cash flow, which could be a bit of a concern, you're seeing largely an okayish kind of picture with regard to Ajmera. Let's go across. We have Nitin Bavisi, who is the CFO of Ajmera Realty, joining us this morning to talk to us about what to expect going forward. Nitin, great having you here. Hi. Nitin, talk to us first off about this project that you've launched in Vikroli, the very strong traction you've seen. Talk to us about where the realizations lie versus the micro market of Vikroli. Are you seeing realizations inch up at all? And just trying to understand, is demand still there at the kind of price per square foot that you're pricing the project at?
So very good afternoon, and thanks for this opportunity to showcase our credentials. Yes, Vikroli project launch has been very, very successful. The first phase, which is almost 80% plus, which we have sold out in the first 24 hours of the launch. And that is something very, very exciting and overwhelming to us. As regards the realization, we are in tandem with the overall micro market realization. From our internal estimate, we have seen a price or the realization which is a bit better than our internal target. So which is also very, very positive, which we are seeing. And this being the first phase kind of a thing, we have further about less than a lakh of square feet of the next phase, which is available to launch kind of a thing, and which is also going to see a great because of the kind of velocity which we have enjoyed and the price point which we have achieved. So we are quite bullish onto the balance of the first phase and as well the next phase kind of a thing.
So Nitin, give us an indication. Does that mean that your next phase gets launched quicker than what you were earlier penciled in, just because of the traction you've seen here?
Yeah, it's absolutely on the, very much on the card to launch kind of a thing in the span of at least about a quarter kind of a thing. And yeah, that is something which we are, because we want to keep the sales velocity, which is the micro market demand is so strong. And we want to keep the, sales momentum on.
Understood. Okay. And how quickly does that launch? If you can give us an indication.
Somewhere, as I said, that, in a span of about 1 or maximum 2 quarters.
Okay, 1 to 2 quarters. Okay, excellent. How much of GDV does this bring to you, Nitin?
Overall, the project GDP is about 700 crore, and out of that, the first phase and the sales so far, which we have achieved, is about 400 crore. So we have further about 300 crore of the GDP from the inventory and as well the next phase kind of a thing.
Got it. Nitin, when you launch, how much? So when you actually book a sale at this point, where you've just about launched a project, how much of the cash do you realize upfront? Give us a sense of that. Is it around 2 to 5%, if I understand right?
So typically, it's always the function of the, the nature of the sales kind of a thing. The first one, the launch which we have done is the mix of CLP and as well the scheme-based kind of a thing. But to give you the sense on the collection, in the span of about first quarter kind of thing, we are hopeful to collect at least about 20 to 25% of the sales book.
Okay, okay. So in this quarter, which is Q3 itself, will you collect 20-25% of the sales book of around 400 crore?
I said in a quarter from the sales, so it might travel beyond this Q3 as well. But yeah, that's the timeline on which we are working.
I get your point. And what about the overall GDV that you're planning for FY26 full year? Your guidance is 6,400. You've done 2,100 crore of launches. Are you confident of the balance 4,300 crore to do it in FY26? At least that's the guidance.
See, we have just come out of the NGT and the environment-related regulatory challenges in August 25, and we are trying to fast track the rest of the permission process and try to bring the launch kind of a thing, and which is about 4,500 crore worth of the launch, which is the balance available as on Q2 kind of a thing. Out of this, Vikroli got launched, and rest of the project we are quite on track, but minor aberration here and there because of the uncontrollable factors on the regulatory side.
Sure. So are you saying you might not achieve the 6,400 crore GDV that you've guided for in FY26?
It is absolutely on the course, but as I said, the bit of the uncertainty and coupled with the the BMC election, which is also somewhere immediately now. So those kind of uncertainty is also hovering and putting the pressure onto the available for the launch and the permissions kind of a thing. Otherwise, from we are quite hopeful that we will bring on the given timelines kind of a thing.
Okay, understood. So that will take your total GDV, Nitin, to around 13,000 crore. Am I reading that right? Is that the right way to look at you?
So 6,500 is the annual GDP for the launches, which we have given as a guidance. And out of that, this number is a part of this very 6,500 crore.
Correct. And you already have 6,500 crore of GDV, which you've already launched, right? So you have a total, if you were to launch the 6,500 crore GDV, that will likely be 13,000 crore of cumulative GDV. Is that the right way to think of this?
No, I think the overall GDP of the new launches is 6,500 crore. And out of that, the first phase of the Manhattan, which is launched in the Q2, the Vikroli, which is launched now, and then the rest of the 4,000 odd crores of the GDP is going to be launched in the Q3 and Q4 kind of a thing.
And how do you execute this entire all the projects which you are currently working on, all that you've launched? Can you execute them in the next 3 years, 4 years, 5 years? What's the timeline like for all of the for completion of all of these projects?
As such, we undertake the project, our internal estimates and as well endeavor, to play within the cycle, and the timeline is about 3.5 to 4 year maximum.
Okay. So in 3.5 to 4 years, you'll likely do 13,000 crore of sales, which you will book on your P&L. Is that the right way again to look at this?
So this is the only launch. This is the only launch of 6,500 crore which we are targeting in this FY26. As we move forward, there would be additional launches as we move forward in FY27 and onwards, kind of a thing. So the pre-sale number is definitely going to be the higher kind of a thing available for launches.
Understood. And are realizations holding up, Nitin, in the Mumbai micro market as well as, or in the Mumbai market, in the MMR market as well as in the Bangalore market? Are you seeing realizations hold up fairly steady? And is there any upside potential to your realization number on per square foot basis of 28,000, which you've clocked in H1?
So our sense that, the numbers which we have received, and the Q2, we have the, almost 22K plus going up to 28 because of the, high price project, which is the Manhattan, which we launched, and the significant of the pre-sale sitting into this number, that of the Manhattan. But coming to your, point regarding the realization, we are seeing the realization holding up, and we are seeing the sustaining sales as well coming at a decent and the stable price point kind of a thing. So yes, hopeful of their price point will remain and remain stable, and going forward the balance of the inventory also will have the better markup because of the visibility and advanced stage of the execution of the project.
And typically, what's the margin like on your projects, and what's the debt outlook like for you? You've guided for 0.85 to 0.9 times debt to equity. You're currently sitting well within that. What are you going to take on this further debt for, and how quickly do you expect to take that on?
So our guidance was that of 0.85 for the FY26 was on the basis that we will have this aggressive launch pipeline for the FY26, which is about 6,500 crore. So project level requirement, that of the debt for the initial approval and as well the execution cost, which we need to support through our working capital credit lines kind of a thing. But we are very, very excited to see that, the initial velocity of sales and as well collection, as I guided, in the span of about a quarter, we will be collecting like a Vikroli about 20 to 25% of the collection. Then in that case, I don't have to, leverage or dip into my credit line. My sales and the operating cash flow will support the execution and the show forward. So then in that case, this particular, and that's the reason we are, as a September ended, we are at 0.55. And given this kind of a cash flow backing, we try to remain in this particular range. Yeah.
Right. Nitin, the way I understand the numbers, very likely you will exceed the guidance that you've given on the Q2 call of 2,800 crore in terms of free cash flow in the next 4 to 5 years. I believe you'll do that very, very quickly. Am I right in thinking that, or have I got the number wrong?
I want to take the baby step, like, the FY26, which we have given the guidance of 1,600 crore. And on a half year basis, we are absolutely there. And yes, you can take the maths that, the one single project launch of Vikroli has given me 400 plus crore of the sale, which was my quarterly requirement for, meeting the, quarterly to reach out to my annual guidance, which I have done out of one particular project. And my rest of the portfolio is available. So definitely we are going to play above average as we move forward for FY26.
Okay. Nitin, that's all. Unfortunately, all the time we have. So I'm going to have to let you go. Thank you so much for coming in and speaking to us. Of course, this was very insightful, and viewers completely out of time on this edition of AAYC. Thanks for tuning in.